All right. I have a question that someone sent in. He's actually a viewer of subscriber of Aaron Clary. He wrote in and said, "Hey, Craig, I'll give you the specifics of my situation. Home was $265,000. Rate was 7.5%. My monthly payment, mortgage insurance, and homeowners insurance is $24.71 a month. I have about 25,000 of miscellaneous debt, auto loan, balance transfer, no other student loans or obligations debt wise. Take home is 2,500 bucks twice a month, and a decent amount of side work to pay monthly expenses like food, gas, and insurance, etc." And then he goes on and writes, "I keep seeing these offers from Rocket Mortgage and Quicken Loans and a few others for refinancing at 4.4 to 5.9%. Now, to me, this seems like a trap to get people locked into ARMs. They don't explicitly say if it's a 30-year fixed or an ARM, but it is it safe to assume that they are being purposely vague on the terms in the offer. It's generally a safe idea to assume it's an ARM and not what I want." Fair enough. Yeah, that probably is an ARM at those rates with what the current rates are today, and or probably stacked full of fees on the front end. So the two things you have to watch for are the rates and the fees. That's a fair assumption that that's what's going on there. And it may be like a 5-1 ARM, so it'll stay fixed for the first 5 years and then can readjust, say, 1% a year thereafter. Anyhow, ideally, I'm trying to lower my monthly payment to a more attainable rate so my monthly expenses can go down. 2,500 bucks a month on mortgage is eating me alive. Unfortunately, when I bought the house, there was a couple unexpected surprises outside of what was already on the agenda to fix. Hence why the credit cards needed to get balance transferred. 60 days of hell, everything broke at the worst time. Yeah, that happens with home ownership. It's not all magical fairy dust in your world comes, super simple and easy. It's a hard route, but it does pay off in the long run because it's kind of a forced savings plan. It hedges you to inflation, and you do build equity over time. So with that being said, I've got similar stories. I was a realtor and the GFC, right? The housing crash. We go into that and I've got a rental property and I was on top of the world. Suddenly I'm upside down on all my real estate. I owe more than they're worth. Values drop by like 40%. And then my water line goes out on my rental property. So normally you're responsible up to the curb stop. That's where they shut off the water. But in this city, their infrastructure is starting to get old and failing. So then they just made a law where the homeowner is responsible from the curb stop to their main. So that happens to be under a very busy road. So I had to replace the whole thing, and that was like $6,000 or $7,000. I forget what. And I had to use their few contractors that were union, and so then not too long after that, the sewer line gives way. So then I have to replace the sewer line, and that's a lot more expensive. That's like 10 or 12,000, I think. So I had those two back to back, and no income coming in because of the GFC. Right, just the house sales were just abysmal. Right, banks weren't lending, but everyone was short on cash. It was the closest thing to the depression we've been at. So anyhow, I weathered that, and then not too long after that, 6 months after that, a sewer line went out at my house. So I had two sewer lines and a water line all go down that year, and it took me a long time to dig out from that. So that stuff happens at the worst possible time. That's just the way it goes. Um, but sounds like you've managed to get through it. You have some extra debt as a result. Okay, welcome to the real world. So you're doing well. That's just the way it rolls. Anyhow, he goes on to write, "I feel like ARM type mortgages are for gambling addicts or people that don't like consistency and stability in their monthly budget. But I'm much more of a fan of taking the safer traditional approach. Absolutely. Be conservative. You don't need to take high risks. Is it a good idea to start looking for refinancing now, or should I keep waiting? My current mortgage broker said I can refi at 6.79% today, but I don't think the math on that makes sense quite yet, as it would lower my monthly payment, but not significantly enough to substantiate the closing costs. Yep. You're spot on. The crux of the question is too good to be true refinance offers through a lot of those second rate things like Rocket Mortgage, Quicken, hard to be ignored completely, or should I be paying attention to some of those? I would like to wipe out my balance, transfer the other miscellaneous debt, and roll that into refinance if possible. I know refinancing a home is another way you can sometimes move that around, which I'm not trying to constantly leapfrog money from one hole to another, but I feel like refinancing debt through a mortgage can sometimes give you the breathing room that you need to get back to a spot where your cash flow isn't so hammered. Thoughts? Okay. Absolutely. You can borrow against your real estate. That is the beauty of it. Once you build equity, and then you can use that for debt consolidation. You can use that as an ATM machine, go buy all the boats and jet skis and all the fun stuff you want. Um, not always wise to do. So I'll kind of run some basic numbers on that. You are spot on the offers out there are going to be arms, probably like a 5-1 arm. So that's going to be fixed for the first 5 years, and then might adjust for 1% a year after that, whatever the specific terms. There used to be like a 7-1 arm too. I don't know if that came back out again. There's different programs out there that come and go. So I'm not a loan officer. I work with the products a lot, but I don't know all the current offerings that they have. But a 5-1 arm would be fixed for the first 5 years and then can adjust like no more than 1% a year thereafter. And then there's a lifetime cap on that as also. So it's not as high risk as it sounds, but it can actually put you in a bad spot if you're not careful. Okay, so the first thing I see is I did get some further information. So the appraised value, we don't know exactly what it's going to be, but just a guess, he thought it'd be around 315,000. And if you paid 265, I think, what does that math come to? You're going to need that appraised value to get a little closer to that 324 mark. You're going to need 20% equity to really do anything over 20% equity. So typically a lender isn't going to re-lend you cash out refinance at like 95% or 100%. They're going to want to see you have skin in that game, because that's just going to be their threshold of risk. Is you're not going to walk away when you have that much equity. So maybe you can find a lender that will go a high balance on that, but you're probably going to pay a little higher rate. You can ask your lender, but every time I've looked into it, it's always been you need at least 20% equity in the deal. So that would mean you'd have to get that appraised value up around that 325, 324, 323, wherever that falls in. There's a couple ways you can do it. If you can find a way to create another legal bedroom, that would give you a quick value add. Finish off a basement can give you extra additional square footage, or turn like a 3-season porch into a 4-season porch to give you additional square footage. Something that will pull some higher end comps for you. Those are the biggest, are like adding bedrooms and square footage versus like kitchen remodels and stuff. That's kind of a finish that's a little more arbitrary versus actual hard numbers that an appraiser can use to move the comparable up. So that would be one way to build equity, to be able to tap some of that equity for other purposes. And then you had mentioned that you were concerned about having the rate not low enough to refinance. So let's just say on the low end, your balance is right around 255. I'm guessing, just based on like a 3 or 5% down. You've owned it for a few years, so you're probably on the low end of refinancing fees is going to be about 1.5%. That's going to be pretty low. Some of these are really going to stack those fees up there. So let's just say minimum, you're going to be 4,000 or 5,000. So you add that to the 255, you're going to be about 258 or 259,000. And that's where you're going to need that value up around that 324. And then let's just say you refinance that 358 or 359,000 at that 6.7 that your lender quoted you. Your interest payment is going to be 1445. Your principal is about 230, give or take. Then you're going to have mortgage insurance of about 184. Currently, your mortgage insurance is about 188, and the number I'm using based on that is 0.85% annually. That's kind of a rough number. I don't know exactly what you're paying, but I'm going to guess it's in that ballpark. And then you've got about $1,600 a month on interest, 190 on principal your first year. I think you're 4 years into it, so you're probably closer to 250 on principal now, and maybe 1,540 on interest, but you're still paying the 188 mortgage insurance. So this is a conventional mortgage. An FHA mortgage, you can't do this. And that's why a lot of people don't like to do FHA anymore, because you can't get rid of that mortgage insurance. However, you're on a conventional mortgage, you can have that reappraised, and you can ask the lender to remove that once you hit 20% equity. So you're going to want to get that value, the appraised value, up as high as you can, and keep that loan balance as low as you can to get that 20% equity, and then go in and make the request to have that mortgage insurance removed. They're going to ask you to fill out some paperwork, and then they're going to have an appraiser that they're going to have you hire, which is going to be $600 and some bucks. And then if you meet that criteria, you can remove that mortgage insurance. So that's going to be your quickest way to get your payment down. And before you start stacking more debt on there or waiting for mortgage rates to drop, you can immediately work on trying to get rid of this mortgage insurance. So if you are going to wait for rates to drop, you're going to have to wait a while, because I think if you go to 6.5%, you're going to save about $110 a month. 6.7, you're going to save about 93. So you're going to have to be in the mid fives to save as much as that mortgage insurance. So that mortgage insurance is what I would focus in on. And to do that, start pulling your best comps, figure out what the true value, what your house would really appraise for. If you're close, see if you can add some square footage, add a bedroom, something to increase that value. Maybe your lender might have an idea on how to bump up the value on the property. I'm not sure where you're at or what the property's like, but there's ways where you can force some equity, force some appreciation on that property for the appraisal standpoint, and then get your 20% equity, get that $188 a month on mortgage insurance back to you, and then you can use that to knock down your credit cards. So that's what I would recommend. And we're in a tough time right now. The inflation has really pinched everybody. All my renters, they're hurting. I'm in real estate, sales are down. Everybody's pinched, right? It's one of those times the economy does this ups and downs. I've been through several of these. They do pass. This one I don't think is going to be that deep and that long. But it is kind of tight right now. So just keep working, keep your nose to the grindstone, keep doing what you're doing, asking the right questions, keep looking at, rates, but your gut's right. Those are teaser rates. And you have to look out for the fees and then adjustable rate, that kind of thing. It sounds like your lender's spot on. Rates have been kind of volatile. Last week they did hit down at 6%. So that would have been a nice time to hit, but they only lasted there a couple days. So keep in touch with him. So if rates do drop again back to that 6% or high fives, then it might make sense to do that. And then if you can keep that without pulling equity out and refinance, and then keep that, or get rid of that mortgage insurance, so you get a lower rate plus where you remove the mortgage insurance, then maybe you can save like $200-300 a month. So then that makes sense, but you're going to need those rates to drop probably right around 6 to really start to make sense. 6.5 starts to make sense, but you might want to be right around a little closer to 6. That's kind of my opinion. And it'll take a few years to pay back because you're going to stack the refinancing costs back on top of the loan. So you got to make sure that they don't put too many fees on there to screw up your 20% equity. So those are my 2 cents. You're asking the right questions. I do appreciate the questions. If you got any further questions, feel free to reach out. And then my email is on the description on the YouTube page there. If any of you others have questions, just feel free to reach out to me. Easy for me to say. And that's what I got for tonight. So hope all is well, and I will talk to you soon. Where is my window here? All right. Have a good night.